The market is completely wrong about Netflix stock. In the past 6 months, Netflix stock price fell 15%. But as a Netflix shareholder myself, I'm more bullish than ever. I'm going to show you why Netflix's recent earnings confirm my bullish thesis. Then at the end, I'll reveal my updated valuation model for Netflix stock. Looking at this chart of the stocks in my portfolio, we can see that over the past 6 months, Netflix stock fell over 15%, and it's down a total of 31% from its all-time high. Significant underperformance compared to the S&P 500, which is up over 5% in the same period. But what's actually happened in the past 6 months to cause Netflix stock to underperform? In December, Netflix announced a deal to acquire Warner Bros. Discovery's film and streaming assets in a deal worth $72 billion. The announcement of the deal caused Netflix stock to crater. Then in January, Netflix announced their fourth quarter 2025 earnings, reaching 325 million subscribers, despite impressive ad revenue growth, increasing by 150% year over year, beating on earnings per share and revenue. The stock continued to fall. The price hit as low as $76 per share. But then on February 26th, Netflix announced they'd be dropping their bid for Warner Bros. After Paramount's deal was deemed superior. This created a huge bounce in the stock, up from $80 to $100 per share in a few days. And then on March 26th, Netflix announced they'd be raising subscription prices across all streaming plans. This reaffirmed my thesis that Netflix had stronger pricing power than most investors believed. And the market seemed to agree, as Netflix stock rose from $93 to $107 per share. But that momentum didn't last, because on April 16th, Netflix reported Q1 2026 earnings. They reaffirmed their growth expectations and announced the departure of their legendary co-founder, Reed Hastings. The market really did not like this. Netflix stock fell 10% in a single day. Weeks later, it still hasn't recovered. So we're going to take a look at Netflix's recent earnings call to see what actually happened inside the business and why I think the market is completely wrong here. And then I'll show you my updated valuation model for Netflix stock. Netflix maintained their guidance for 2026. With revenue growth of 12 to 14% and operating margin of 31.5%. As a Netflix investor, the company maintaining guidance wasn't a problem, but the market seemed to believe that Netflix would be in a position to raise guidance when they weren't, causing the stock to fall. Advertising business expected to roughly double to about $3 billion in 2026. For me, this was huge news. Advertising revenue doubling to $3 billion is very fast growth for a company at Netflix's size. But I think that size is the reason they're able to scale ads so effectively. I saw one analyst call Netflix the cable television for the world. You'd expect ad revenue to grow at a significant pace over the next 10 years. Alphabet-owned YouTube already produces around $40 billion in a year in ad revenue, compared to Netflix's $3 billion, suggesting Netflix has a significant runway for growth in ad revenue. And advertising should be accretive to margins long term. Netflix ended 2025 with 325 million paid members, audience approaching 1 billion people, including account sharing within households. Still under 45% penetration of addressable households with smart TVs and good broadband, which is estimated to be 800 million households and growing. This is Netflix saying that despite their huge audience, there's still a long runway of growth ahead of them. Netflix estimate they've captured 7% of their addressable revenue pool, which is $670 billion in 2026, and about 5% of global TV viewing time, underscoring long runway for growth. Strategy priorities: strengthen core film/series slate, originals and licensed content, expand into podcasts, regional live sports and games, leverage technology across delivery, discovery and production, improve monetization via pricing, plan design, distribution partnerships, and ads. Then they go on to give details about the failed Warner Bros. Deal. Original 2026 guidance assumed $275 million of mergers and acquisition related costs, including the now closed Interpositive acquisition and prior expectations around the Warner Bros. Deal. Some Warner Bros. Related costs that had been modeled for 2027 were pulled into 2026, while other anticipated costs will not materialize after walking away. Net result: total merger and acquisition related expenses are still in the ballpark of the original $275 million assumption. Management reiterated there is no material impact on operating margin outlook and no hidden step up elsewhere in expenses tied to the failed Warner Bros. Deal. Then Netflix gives some details about their mergers and acquisition strategy. Warner Bros. Transaction reiterated as nice to have, not need to have. Confidence in the core business remains high. Netflix proved it can execute a very large deal, bidding, regulatory planning, and early integration work all validated internal M&A capabilities. Key muscle built, deal execution, integration planning, and most importantly, investment discipline. Management walked away when the deal economics no longer made sense, emphasizing willingness to override emotion and ego when value turns negative. No change to capital allocation priorities, invest organically, pursue selective, disciplined M&A like Interpositive, maintain strong liquidity, and return excess cash via buybacks. M&A will remain a tool, not a strategy in itself. Discipline used in the Warner Brothers process is the template going forward. So despite not acquiring those assets, Netflix management team feel they gained some sort of experience by going through the process that may help in future. Personally, I'd rather they stay away from big acquisitions and focus on organic growth. In terms of engagement, overall viewing hours grew in Q1 at a similar rate to 2025, despite Q1 including 17 days of Winter Olympics competition for viewer time. Netflix's primary member quality engagement metric hit another all-time high in Q1 after a record in 2025. They use a multi-signal framework for engagement, not just hours watched, and validate metrics by how well they predict or explain core outcomes like retention. Different content types are measured differently. Live events can have a lower total hours but higher acquisition or retention impact. So valuation models are tailored by format. So overall, engagement is improving across the board as expected. The company then gave details about its live sport and entertainment strategy. World Baseball Classic in Japan was Netflix's most watched program ever in Japan and the largest global baseball streaming event on record with 31.4 million viewers. WBC delivered Netflix's largest single sign-up day in Japan and contributed to Japan having its best ever quarter of paid net ads. Also served as first major regional live event outside of the United States and tested concurrent multi-game streaming. Q1 strength in APAC went beyond WBC. Strong performance in India, Korea, and Southeast Asia. APAC was the strongest FX-neutral revenue growth region. WBC created a halo for other titles, for example, One Piece, and gave a boost to ad sales in Japan. So it seems that Netflix has dialed in their strategy for live events, not just in the US, but around the world. They seem to use major live events to drive signups in a specific region and trust that their slate of global and local content can retain those new subscribers long term. Core sports thesis unchanged. Focus on big breakthrough events rather than long regular season packages. ROI evaluation incorporates both direct viewing value and indirect benefits like higher ad CPMs and broader engagement brand impact. Netflix has built a track record with live sports and events, opening night MLB, Christmas Day NFL, fights, WBC, etc., and sees NFL as a valuable part of the offering. They're in discussions with the NFL to expand the relationship, but within the same event-focused economic discipline. Recently announced a multi-year CONCACAF rights deal in Mexico, Women's World Cup rights in the US and Canada, and are ramping sports events globally with a local-for-local approach. So it seems that Netflix is avoiding large season-long sport commitments and focusing on those single events that can provide outsized returns for the business. Then we get into Netflix's podcast strategy. Early data shows podcasts are incrementally additive to engagement. Consumption skewed to daytime, when Netflix historically has lower usage. Consumption skewed to mobile, capturing more usage in context where long-form TV or film is less prevalent. Strategy is to both license and create podcasts. Examples include the Bill Simmons podcast, The Breakfast Club, Pardon My Take, Therapist from Jake Shang, The White House with Michael Irvin, The Pete Davidson Show, and companion podcasts like Bridgerton Official Podcast. New podcasts announced from multiple high-profile hosts, indicating a growing slate. Goal is to meet members where they are, especially mobile, and deepen fandom around key franchises via companion and universe-building audio. I think Netflix sees strong utility in podcasts. It's a way they can keep members on the platform during different times of day and on different devices. Without podcasting, these use cases might not exist. Now we're diving deep into Netflix's advertising strategy. Moving to Netflix's own ad tech stack has made it easier to buy ads on the platform and enabled faster feature development. Programmatic buying is growing rapidly and is on track to become more than 50% of non-live ad revenue. Advertiser base grew over 70% in 2025 to more than 4,000 advertisers, a key health signal. Current focus remains on largest global buyers, typically serviced by Netflix's own sales team, directly or in tandem with direct service providers. Over time, they expect more advertisers overall, a higher share of spend to be programmatic, gradual expansion from top-tier brands into mid-market, and broader long-tail, following the time-tested digital ads playbook. If Netflix can get their advertising strategy right, this is potentially tens of billions of dollars in annual revenue within the next decade or two. Then the company shed light on their pricing strategy. Recent US price increases were planned and incorporated into the full-year guidance. Pricing changes are rarely unplanned. Decisions are driven by sustained improvements in perceived value ahead of price moves, using signals like quality-weighted engagement, planned selection migration, retention and churn, described as industry-leading. Early read on the latest US increase. Trends are in line with expectations and similar to past price changes. The rollout is still in progress. Netflix positions itself as offering among the lowest cost per hour of viewing in the US streaming video on demand. In some cases, competitors can cost roughly 2 times as much as Netflix per hour. The $8.99 ad-supported tier is framed as a highly accessible entry point with strong value. Retention improved year over year in every region in Q1, consistent with record highs in engagement quality metrics. So again, I just think there's so much room for Netflix's pricing to expand from here. There's so much excess value that Netflix's ecosystem provides that is going straight to the consumer. And that's why they love Netflix. Then we have Netflix's AI strategy. Netflix sees Gen AI primarily as a tool to improve content production, enhance member experience and personalization, strengthen advertising products and operations. The philosophy is AI will give great artists better tools. It will not replace the need for great artists. Current creative use cases include set references, pre-visualization, VFX sequence prep, shot planning, improved on-set safety from better planning and visualization. And then they go on to speak about the interpositive acquisition, viewed as an accelerator for generative AI capabilities with tech tailored specifically to filmmakers, differentiated from general-purpose generative AI video tools. Early interest reported from creators who've tested the tools. Adoption is building, though integration is still new. Broader tech focus areas. Member experience, new recommendation architectures to improve personalization, integrate new content types faster, and increase engagement. Advertising, AI within Netflix ad suite to create new ad formats, improve contextual relevance, streamline creative development and deployment, and make tools easier for advertisers to use. Their investment focus is guided by where Netflix has unique data, scale, and distinctiveness, and where there are large-scale products or processes to attach AI to in order to get leverage. And then finally, we have the departure of Netflix's co-founder, Reed Hastings. Reed Hastings, the founder and board chair, has decided not to stand for re-election. He remains on the board through his current term. Management emphasizes decision is consistent with long articulated succession plans. Reed has long said Netflix must outlast him, and he expected to fully transition within roughly a decade of first steps. Timing is not related to the Warner Bros. Deal. Reed was a strong proponent of the transaction and supported it alongside a unanimously supportive board. Board, a nominating and governance committee will manage board reshaping over the coming months. There were extensive tributes from Sarandos, Peters, and Newman, highlighting Reed's role in defining Netflix's culture of risk-taking, transparency, change embracing, and member-first decision-making. Emphasize his unique leadership style, debating vigorously yet fully backing decisions once made, and being generous with credit and responsibility. They frame his exit as a model for thoughtful, graceful handover of leadership rather than a reaction to any specific event. Leadership continuity, Sarandos and Peters underscore they intend to carry forward Reed's principles in strategy, culture, and decision-making. So with the earnings discussion out of the way, it's time for your favorite part of the show. Valuation. I'll reveal my updated valuation model for Netflix stock towards the end. On a price to earnings basis, Netflix trades at a 28 forward PE. Factoring in 2027's expected growth, the PE falls to 24. If we compare this to YouTube's owner, Alphabet, you can see they're not too far apart, with Alphabet's forward PE ratio sitting just under 29. But then if we compare Netflix's 28 forward PE ratio to Disney, Disney trades at a mere 14 times forward earnings. You might think this means Netflix is clearly overvalued or Disney undervalued, but it's not that simple. Although Disney has its own streaming service, much of their business produces lower margin revenue. For example, their theme parks and cruises. And their cable business is in structural decline. Netflix is a pure play, high margin streaming service which is only becoming stronger as time goes by. Netflix is currently trading at its lowest price to earnings in the past 3 years. If we look at Netflix's PE over the past 5 years, we can see the big drop in 2022. The market got scared that Netflix was losing subscribers. Since then, Netflix has gained an extra 100 million subscribers. Netflix's free cash flow yield sits at 3%. The higher the free cash flow yield, the cheaper the stock, and vice versa. You can see from this chart that Netflix is trading at the high range of its free cash flow yield over the past 3 years, suggesting the stock could be undervalued to some extent. The reason I use these historic valuation charts to guide my thinking is that every company is unique. It's fine to compare a company like Netflix to Disney, for example, but they are incredibly different businesses, as mentioned. Now let's update my valuation model for Netflix stock. I'm going to use earnings because Netflix's free cash flow can be less reliable due to content spending cycles. First, we need to figure out what growth rate to use for Netflix's EPS. We can see that over the past 10 years, Netflix's EPS has grown rapidly. Over the past 5 years, it's grown at an annualized rate of 30% due to a combination of price increases and membership growth. I believe that Netflix's pricing power persists and that their subscriber count will continue to grow, alongside explosive advertising revenue. Add to that the potential share buybacks at between 1 to 2% per year, and we could see EPS growth of 20% annually over the next 5 years. Then for Netflix's EPS multiple, meaning the PE ratio, I expect some increase in multiple from today's trailing 30 PE because as the company grows, it's becoming substantially more profitable. Operating margin has increased from around 25% to almost 35% in the past 5 years alone. I see no reason why Netflix's operating margin can't reach beyond 40% with its pricing power and continued high margin ad revenue growth. So in that case, I'm going to use a 35 EPS multiple for our Netflix stock valuation model. This 20% EPS growth combined with a slight multiple expansion to 35 times earnings produces a huge outcome, which reinforces the idea that the market is completely wrong about Netflix stock. With these assumptions, we could see just under 24% annualized gains from today's price of $92 per share, increasing to $270 per share by 2031. That's almost a 3x increase over 5 years, and why I believe that Netflix stock is a great buy right now.